It's Wednesday morning. It's 8:30 Pacific time. We're watching the market rally a little bit here. I'm sure everybody's sold their inverse ETFs and hopefully locked in some profits here on the buy signal. Hey, Dr. K, you there from London?
Sure am.
So what's the story here as far as the model changing signal to a buy?
Well, it was interesting. We had a rare confluence of events. First, we had undercutting of a prior significant low across all major averages. Secondly, we had a huge volume buying during the last hour of the trading day. Essentially, it pushed the model at first into a cash signal just after the close. But after further analysis, the model has moved to a buy signal simply because we are in a very volatile environment, and odds favor that this is not going to just be a one-day reversal. In other words, this bounce could continue for a few more days. Now, what the model is going to look for is how strong this bounce is in the way of the action of leading stocks. So if the bounce is strong, then, of course, the model will stay on a buy signal. If the bounce is weak, depending on how weak the bounce is, the model is either going to switch into a cash signal or potentially a sell signal.
We had a couple of questions this morning, Dr. K, regarding TIBX, I think it was. I'm sorry. Base count reset. I mean, given the buy signal, some people were asking about base count resets. And
Sure. The base counts, they're reset when a stock undercuts the low of its prior base. So if, say, the stock has formed a second stage base, then launches out of there, and then in the ensuing weeks heads lower and undercuts the low of that second base, that is a base count reset. So you start from base count number 1 all over again. The other possibility is when major indices drop by at least 20%. You'd want to see that occur in the S&P 500 or the NASDAQ composite. And when that happens, you could elect to say that all base counts across the board are reset. The logic being that when the market goes into a bear phase, once it comes out, it's ready to form a new uptrend. So in theory, even if you have a stock that didn't undercut any of its prior bases, if the market's ready to move higher, there's no reason to penalize a stock that's showing unusual strength in such a market. So that stock, for all intents and purposes, will also have a base count reset to back to 1.
everybody get that? Okay. Let's see. What if the prior base is part of a base on base? Does just the last base need to be undercut, or does the whole base structure need to reset, be undercut in order to reset the count?
The whole structure, the whole base on base structure. In other words, the stock has to undercut the low of that base on base structure.
Right. So in that case of Apple, if you consider this a base on base, I would tend to think that you're going to have to undercut the lows here to create a big reset on Apple. And I think Apple's still going lower, even though we have a buy signal on the market here. Currently, I think that you're going to see a lot of these stocks give way eventually. As far as I see it here,
Apple would have to undercut 310 and 50 cents, 310.5
right.
For this base, for it to base reset.
Right. So, I think it's pretty obvious. Once you undercut, this is what we were looking for. When we were up here, we were talking about holding on the sell signal because we felt a retest of the lows on the NASDAQ was coming. So we got that, and hopefully everybody made money on that. I know I did. In 8 days alone, I was up 48.6% in my shorting account. Of course, that's being short some of these names from Netflix to Apple and CMG and everything in between that we've been talking about. So, 8 days we can pull that off.
For people out
the market holds over again,
on,
I think that these stocks are going to roll over and head lower. So this undercut to me is normal. Now you got 2 days of a rally, and we'll see what happens. If you go back to 2008 on the NASDAQ, and I'm just going to leave the volume alone, so we'll go back to 2008. Everybody see the charts okay there?
Hey, can you hear me, Gil?
Yeah, I hear you fine.
Oh yeah, I just wanted to say to qualify for people out there, you know, 48.6% is a huge figure in 8 days, but they should also know that you know, you are swinging pretty wildly for what, 400% sometimes intraday. Is that right?
Yeah, I can be heavily short, you know, at different times of the day, intraday, to
Right.
achieve that. So you have to sit through a lot of volatility.
So it's a matter of position
Right,
sizing.
right.
You know, everyone should always
Right.
know that. You know, to get the big percentages in such a short amount of time, you got to take huge risks. So in other words, you know, and some people have no problem taking such risks, and others are going to be more conservative. And naturally, the TVIX is a great example of that. How volatile a vehicle can be.
So, but the point is, you know, I can come down hard, but I can also go up very quickly when things are in my favor. So here I'm actually looking for a spot to short into this rally. So what I want to talk about is, okay, we know the market is rallying, and if we go back to 2008, let's go head back here. So here's 2008. When the market, I'm sorry, 2007. We're going to the top in 2007. When the market broke off the peak and it spent about 8 weeks going sideways, as it started to break down, you had this undercut, which never led to a rally, but you did get a point where you rallied for a couple of days here because you're coming into this low over here. So I'd watch for an undercut. If it's going to fail, probably fails within 2 to 3 days. Otherwise, you may end up drifting higher on the NASDAQ for a period of time. But for right now, we have a buy signal. I'm not buying any stocks myself. You could try and buy ETFs, which so far would be working slightly for you. But I don't think I necessarily want to go hog wild. If I'm looking at individual stocks, you can see how using price targets, and in this case we were talking about this low and the 200-day being an area when we got into this zone down here where you want to be covering on Apple, and you see the break very quickly. And this is very typical for late-stage failures where a stock will break down through the 50-day once very hard and almost textbook going into the 200-day moving average here. So the bounce, I think, is to be expected. And with that bounce, I think it might carry. I look for it to carry up in the 384. But usually what will happen after this, but you might have a retest of the 200-day moving average, or you may just shoot back up and then test the 50-day moving average on the upside for a period of time. So you got to keep an eye on that right here, I think, and where that goes. Also, GMG, same thing here. You can see it broke down, got down to this low, didn't quite undercut it, but yesterday when the market turns like that and you're getting close to a prior price target, then even if it's moving away, I think you have to come in and cover and take some profits. And CMG seems a little bit weak in here, so I think it's probably shortable coming up into this 300 level, so I'd be watching for that. It could get up to the 50-day if the market continues to drift higher, but we'll see. You know, this could also be the start of a new rally phase in the market, and that's always a possibility. So you don't really know. So we're kind of in a comfortable position. I think we locked in some very nice profits coming into the low yesterday, and we're back on a buy signal. So how you want to play that, I guess, is up to you. If you're a purist, you just go long a 3 times ETF unless the market reverses either to a cash or a sell signal. Dr. K, you have any advice for people as far as how they should handle this with ETFs?
Sorry, say that again. You're coming in a little. There's a little noise on the line. I don't think it's from your end. It might be just the connection, like that rumbling.
Yeah, I noticed that too. We're getting some. I noticed cars coming by. I don't know if somebody's on our end is giving us some weird noise here. Pretty strange. Who's that?
I mean, it's all quiet on my end, so it's strange.
Okay.
I don't know if it's the connection. So it's not the connection. It's just external noise.
Seems like it could be. Yeah, I'm not sure where it's coming from.
Huh,
There's
okay.
like a car driving through every once in a while. So, anyways, hopefully you guys can hear me. But
So what was the question?
would you be going long ETFs, just straight long ETFs right here on the buy signal?
Oh, yeah. Essentially, what as that we were advising in that early report, one could either just stay in cash, keep their profits that they made from the last sell signal from August 31st, or they could pyramid in slowly into a position on the long side on an ETF, letting price prove itself. So in other words, they could initiate a smaller than normal position, uh, today at the open, and you'd be up, you know, on some of these vehicles, you'd be up probably a couple percent, depending on if it was a 2 or 3 times ETF, and then let the price prove itself. So every incremental advance you could add to your position.
That's one way to handle it. Let it kind of work for you. That's the way we've been approaching most of these signals. We haven't, the model on the website, we show that if you went long, I don't know, the TY, whatever, TX, what's that?
There's the TNA, the TYA.
Yeah, you'd be up 100 and something percent, but from a practical perspective, it's a lot harder to pull off that kind of performance. I think, though, just from an academic perspective, in terms of showing what the model can do, when you get a good signal, it can generate a lot of profits, at least on a hypothetical basis. But using that signal to guide you, for us, I think we're pushing 40, 50, 60% up for the year, and so, it's following the signals work, but we've taken it incrementally because it has been a volatile environment. And you can see just from some of the intraday action we've had, even on the way down, that it tends to be pretty volatile. So anyways, getting back to stocks that we've been shorting here, Chipotle, I think it's headed for the 200-day. I would even short it here using the 300 level as my stop. So because I think a lot of these leading stocks have broken down, they're heading lower. Okay, so it's Apple. We hit our downside price target. I actually covered my Apple short here. I think it can also be shorted up in here because it may not get past this area, which could be overhead. Now, if it continues higher, then it's probably headed for the 50-day, which is at 384. So keep an eye on that, okay? But I do think it can be tested here. Just be ready to turn and run if things don't work out. Amazon has also broken down. It's through its 50-day. It hasn't gone to the 200-day moving average, and now you're getting this rally today. Up into this area. It could go further, but I think I'd see if it's able to get through this level here. It's not quite breaking down from the 20-day moving average. You're coming up in here. I guess you could rally up into 223. I don't think that's really likely if, in fact, this thing is that weak. But this sort of V-shaped pattern, it's suspect. So knowing that, it's always possible to try and short it. I did short this thing, and when it came down, we talked about getting short up in here using the 20-day as your stop. And we undercut this low here. So yesterday, under 205, 204, you have to start thinking about covering. And I got to tell you, that's the hardest thing to do when that's happening. You're up 8, 9, 10% on the day, and you're seeing Amazon or Apple or CMG, if you're sure, you see them streaking to the downside, but they are getting to your first stage price targets, and you have to start thinking about taking some profits. If you sit there too long, we get back to that old adage of bulls make money, bears make money, and pigs get slaughtered. So you don't want to be a pig. You want to take what it's giving you. And I have to tell you, that's one of the refinements in my short selling. I got clocked selling short in March of 2009. I sat too long. I had stocks gapping up on me 10% in the morning before the market even opened. And I was not taking, and the big problem there is I was not taking profits on the way down. I was trying to sit with these big short financial positions thinking that the whole world was going to come apart and these things would all go to zero. And one of the refinements is using price targets on the downside and then covering when you get there and covering at least part of your position, because when they turn it fast. And yesterday you saw Apple come off the 200-day moving average, and that thing's hauling ass as it comes off the 200-day. And if you're sitting there, or even if you're in the bathroom, it's going to cost you 5, 6 points on the upside if you're slow. So when you see it there, you think, oh, it's going to bust, it'll go to 310, and I'll be able to buy myself a new Mercedes or something. And you start doing that, that's probably the time to cover. But now you can think straight if you're back in cash and thinking about putting it out again on the bounce. Because if you go back, what's interesting about Apple, I'm going to go back to 2007, and I've talked about this before. And if you guys think I'm fixating on Apple, just let me know, but too bad. Anyways, the market topped in October of the end of October, I forget what it was, the 28th, 29th, something like that, in here. And Apple rolled over when the market did, but then it came back out and broke out, tested the 200 dollar level, and then it failed. And when it failed very hard, similar to what it's done today. And notice you get a similar move. It undercuts this low here, and you get a similar move to yesterday, a bounce off from a point near the 200-day moving average. You rally up for one day, and then look at this, the next day you gap down. So today we didn't do that with Apple, but it's very interesting how this could cause you to cover, and then you'd probably be ticked off the next day because the thing gaps down. But then you can use the 200-day moving average as an upside stop and come after it. It takes a little while for it to come loose, but it does go lower. And then finally, that's the bottom in say late February of 2008. But that's very typical, that kind of move. But that was very odd for Apple to gap down and continue lower at that point. Anyways, looking around at some other names that we've been talking about, I'd keep an eye on this TIVX. It's rallying today, probably gets to the 200-day moving average. Stocks like Soda, you know, breakdown, you got a left shoulder ahead, a right shoulder. Now you're coming up into the neckline, probably shortable, coming up into the 10-day moving average. Use that as a stop. Let's go to Cena. We used, remember that we used this low here as our stop, and the stock went through. So if you covered in here and you took profits, I think that's smart, but now watch it coming back up to the 10-day. It might be shortable again. So another one we're looking at was Baidu. And of course, that one worked out very nicely. Just blew apart off the 200-day moving average here. Now it's sort of forming this bearish flag. So my guess is it may go sideways here for a little bit and see what it does. But right now, you're kind of in no man's land. It did get to our price target at about 114, so it came down. It's still below there. If you're going to try and play this for a further gain on the downside, you can. But you know, do you want to be a pig? I'd cover some of it and just take your profit. Heck, don't look a gift horse in the mouth, because that's one heck of a downside move. And if you play that, you can be up quite a bit very quickly. So even if you aren't using, you know, 9,000% margin like I do. Go through a couple others that we've been talking about. I just want to give you some guidance on where we're at with these. Now here's Priceline. See, this fails and this breaks down very hard. You already had one break through the 200-day moving average here, so when it does this, I don't think you need to be covering at the 200-day. At this point, we're looking for this as our downside target, and sure enough, we hit it and closed just above this low here yesterday. Now you've gapped down, you're trading down in yesterday's range. So to me, this looks kind of weak, like it's going to go lower, but it could shoot up. But if you did short any of this move and make some money here, you have to think about taking some profits. So in this whole concept of using prior lows, this is one of my improvements to my short selling technique. I talked about it in the book that when Dr. K and I discussed short selling in, what chapter was that, Dr. K? Chapter 6 or something like that?
Chapter 6.
Yeah, so I mean that's one of the improvements that we made, you know. And the other thing is these patterns that we've identified, they do work. And Dr. K did do a study of the patterns in the book, How to Make Money Selling Stocks Short. And interestingly, he did that before we had teamed up together again. And while we actually were not in contact for a few years when he was in Europe and running a fund out of Switzerland. But anyways, those patterns have a high probability of working when they work. And so the key is finding the right window and being persistent, and then knowing when to take your profits. So you don't need to be a pig. Just decide what you're willing or what you want to get out of the trade and work it that way. And don't be a pig. You know, I know yesterday, midday, looks like everything's going to blow apart, but you got Apple punching down to the 200-day moving average. You got Amazon undercutting that 104, 105 low. I'm taking profits at that point. And I think anything else is just trying to sit too long. Yeah, they might go a little bit lower, but you can always work them from there. And you tend to get waves of selling in a bear market that you're able to work on the short side. So, all right, yeah, we did sign a new contract for it was basically going to be a workbook and study guide as a follow-up to Trade Like an O'Neill Disciple. So that's expected. We're expected to be finished writing that at the end of March, and then who knows when they'll have it published. So. I'm kidding, Thorne. I don't really use 9,000% margin. I think the most they let me go up to is 400. So let's look at gold. People asking about gold. Any other shorts I should be covering? Oh, wait a minute. Let me go over open real quick. You can see open gets down in here. So downside target is was really 44.45. So I think you can take profits on this one. I think it could rally up into the 50 level if the market keeps going. So this one's a little bit down there. I like some of the newer situations that we're dealing with on the short side. They look a little more promising. So, you know, like the breakdowns you're seeing in Amazon, Apple, CMG, how those play out, obviously will determine whether we get shorted again and how this buy signal works out. But I think for now you want to be looking at taking some profits and then maybe shorting into some of these rallies that might work. And I am, in fact, testing some of these. So that's how I'd be handling the short side. Another one I think we've talked about before is RACS. You know, break out through this bear flag and rallying right back up into it. RACS tends to be volatile, so it might even become shortable in here. It could rally up in here. But I think when you undercut this 31 low, right there, that's probably a point, you know, this low or this low, that's probably a point to be thinking about covering it yesterday. But, you know, probably yesterday everybody's thinking about making 500% in one day and not really focusing on where to take profits. But that's a critical aspect to short selling. And whether you make or lose big money, let me tell you. All right, let's go through some questions here. GLD. Gold to us is a dead play. The trend, short-term trend is broken. It's holding the long-term trend line just barely, and we just don't play. We don't bother with it right now. There's no trend that we can identify in it, so we're not going to stay with it. Same thing goes for silver. You know, it's forming a flag here, and for all you know, these things go lower. So, you know, the time to get out was in here and not sit around waiting for things to bounce back and being decisive at that point. Dr. K, any comments on gold and silver?
The long-term, very long-term trend that started in gold in 2001 is still it's still intact. As long as central banks continue to print money, gold should overall continue higher. But in the meantime, it is trendless, and so you shouldn't have your money in gold or silver.
Yeah, so I mean, I have physical gold. That's a long-term hold. That's mostly as a currency hedge. I think if you're looking to accumulate some gold and put some percentage of your assets into gold simply as a currency hedge, I think you use the weakness to do so, and dollar cost average probably into it. That's not something that we do as traders, but you know, there is that aspect of having some portion of your overall wealth allocation in gold, just as a matter of hedging against all these fiat currencies. I do think at some point the poop is going to hit the fan there, but we don't know when. So you know, you use the weakness in gold to accumulate it for that purpose as a currency hedge. You use the strength or the trending strength whenever that occurs to trade it, and that's what we do. So, what sector should we be watching if the rally continues? I don't really focus on sectors. I will focus on individual stocks. So, MAC. Somebody's talking about MAC as a short. I don't know. I wouldn't short it. It doesn't strike me as a real dynamic, big leading stock. Let me see. Let me take a look at this on a weekly chart. I mean, it's one thing you need to understand. I don't know if I call this a big leader. I mean, it looks like it could be shortable, but I'm not going to short it. You say don't be a pig, but the model was on a sell signal. So what? What does the model have to do with shorting stocks? When you're shorting stocks, you don't just short stocks blindly because the model's on a sell signal. You're shorting the actual stock. So you develop price targets based on where prior lows are or where a major area of support would be expected to show up. So in Apple's case, the 200-day moving average coincides with this low, and you could easily see it come down there and then turn and bounce, which is exactly what it did. You handle stocks individually. It has nothing to do with the model. So don't get locked into a little box there like you're some hamster, and when they open the cage door on a buy signal or sell signal, you're going to run through, and that's all you're thinking about. You got to think about what you're doing on the short side beyond what the model's telling you. And that's why even in a case where you have the model on the buy signal or neutral, you can be shorting individual stocks, and that can work. So the models is, in my view, reinforces the short side, but it doesn't mean that you have to wait for the model to go on a buy signal before you cover your shorts, particularly if they hit your prior downside price target. That's why we sent them, and that's why we sent that short sale alert. Is this still the first wave of selling or the beginning of the second wave? Well, we might have looked for it to be the start of the second wave of selling in this market. So, you know, as we're looking at on the, let's see if I can get the right chart up here. Let's see if it's here somewhere. Okay, if this was the first wave, then we'd look for this breakout to continue and create the second wave down, similar to what you had in the top of 2007, as I was looking at on Apple earlier. So, that's what you're looking for. It doesn't mean it has to happen. And right now you're on a buy signal, so that is telling you to cool it. And if we do start to roll over and break to the downside, we will shift to a sell signal again. So really nothing to worry about there. You're welcome. Somebody, Carlo, thanking us for the webinars. Somebody asking, this is an interesting question. Do you take profits when playing an ETF like TZA when it hits logical resistance? No, the ETFs are handled on the basis of the model signal. I don't treat them like a stock. Fossil, good question. Here we go. Pull that out. Fossil came down. You got a head here, left shoulder, right shoulder. We talked about this one when it was up here, very shortable up here, and boom, it's broken down. So, we looked at this as being your target low. It didn't quite undercut it, but it got close. So I would think that going forward, that's probably going to be at support level. So now I'd be looking for it to undercut this low on the next rollover. So it could probably rally into the, let's see, that's the weekly chart. Where's my daily chart? There he is. Oops. So you could rally all the way back up into the 200-day. It's really going to depend on where this market rally heads. So, but you got close, so it could have been covered. If you up here and you got a profit and you feel more comfortable taking it here, you can do that. But at this point, if you're holding this for another gain, further gain to the downside, and looking for it to actually undercut the low, then I would look for that to happen. But keep in mind, if the market continues to rally, it could continue to move higher, and it could conceivably head all the way up into the 200-day moving average. So. Not that clean cut. So at this point, though, you had a nice move. Ask yourself, did you make 15, 20%? Did you take the profit? That's another thing to think about is when you're up 15, 20, 25% on a short sale position, you can think about taking profits on that basis alone. There's nothing clean about taking profits on short selling. You just have to set objectives and then stick to them. Going over some more questions here. Netflix is breaking out on low volume. Whoops. I don't know what you call a breakout here, but I think the stock should be covered here, mainly because you came down on top of this area. If you're short this one, this breakout, you get this last move to the downside on a breakout. You're coming into this area of congestion, so I would think at this point you're so far down you should bounce. But I think this one right now is not a primary short sale target. I'd be looking at other things to be shorting here myself. So I think Netflix probably played out. It could break down lower, but again, you're not seeing a lot more selling, and you were weaker 3 days ago in the market, and you're not getting heavy-duty selling coming in. So I would think that it's probably exhausted on the downside. So I wouldn't mess with it anymore. I'd be taking my profits and moving along. Somebody's asking about retailers. Well, we know Fossil. I talked about that. That's bouncing. But you've got things like Dick's. This broke down, rallying up into the 50-day. Could they be shorted? I suppose so. But you would use, the standard stops. Not really what I'm looking at right now. The retail group has been surprisingly strong. Even this thing came shooting back up, and it doesn't want to break its 50-day. Nordstrom. Tiffany, however, is one that I was focusing on. And that's a lot like Fossil, and it undercut this low. So right there, as it undercuts that low, you can see that's where you want to be covering your short. So, now you're bouncing, and it's hard to say where it could head up into 65, 69, right around the 10-day moving average. In this area, it could be overhead resistance, so you don't really know for sure. But that was definitely a point to think about covering your short was when you undercut that low. And you see how that works? And why does that work? Probably the same reason it's working in the market is everybody sees it as a break of support, and so everybody wants to come running in and short the breach of support. You get a confluence of shorts right there. I think you're able to turn the market there, or the stock, because you have a confluence of shorts running in at that point because they see it as a break of resistance or break of support rather. So as it's coming down through here, people come in, you get a confluence of shorts, they turn them and bounce them. And if you're smart, you use that as a point to cover. So, but you know, the retail, I just focus on, most recently I was just focusing on Tiffany and Fossil. I'm not really interested in the other ones because they didn't really do what I was expecting them to do on the short side. Whereas these, Fossil and Tiffany, remained weak around the 50-day moving averages. So, somebody asking, did you guys sell your inverse ETS before the close yesterday? First point of reference is that what we do ourselves is really nobody's business, but and you shouldn't even try and assess what you should be doing based on what you think we're doing. But I'll tell you straight up, we sold them this morning, so went down about 1% on that, and so we're still up for the month pretty nicely, so no big deal. But we put out the signal first, and then we covered our ETS, or sold them. TZA killed me yesterday. You know, I think the way people talk about losses or a reversal in the market says a lot about their psychology, and so people will say things like, oh, I got spanked yesterday, and I got killed yesterday. It's like, you know, if you were long the TZA on the sell signal and you held it, you made a lot of money. When the market turns, you're never going to catch the exact inflection point. Now, you could have anticipated the undercut in the NASDAQ yesterday and done some selling on that basis or taken partial profits. Our experience in handling the model is that once you get in, you have a signal, you stay with the signal until it changes. So once it changed for us, we bought or we sold the TZA, and right now we're sitting in cash. I think we're not really doing anything. But you know, you didn't get killed. Yeah, the thing reversed on you, but that's just telling you when the trend to the downside in the short term is ending, and so you may get back a few percent. But I won't get into this idea of giving back a few percent, 4, 5, 6, 7%, whatever it is, off the peak, when you should have been making money on this. That's just normal, and that's what will happen. And you know, my motto is you have to lose to win. So things are not always going to be perfect, and you're not always going to have 100% of the profits that you see on your screen, if that's what you're operating on the basis of. So, but just be careful how you talk to yourself. I think you get into this idea of getting killed because something turned like this when you were playing this trend, you're getting your psychology out of a frame of reference where you understand that being wrong part of the time is part of the game. I think that's why a lot of people never make big money, because they don't understand that. And I can tell you my mistakes in the market have occurred when I'm wrong and not letting myself be wrong by taking the loss. Okay. Someone makes a good point about Tibco and Rax. You know, they are small tech companies, so yeah, they're susceptible to being bought out. So you always have that risk, and that's always part of the risk in any stock that you're short, that there's going to be some news that jacks it up. So that's why you have to assess how big of a position you want to take. You know, so you can think about shorting stocks maybe that you think have less of a chance of being subject to some kind of news event like a buyout. Somebody's asking about wash sales. You need to talk to your accountant about that. If you're a trading account, you know, you just take a straight value, and wash sales, if you know, because day traders are in and out of stocks all day long, and if they, I guess, if you use straight wash sale rules, everything they did would be a wash sale. So it depends, I think, on how you have your account. I think 1099B type accounts are subject to wash sales, but I think if you're trading your account as a trader account or as a pattern day trader, it changes the accounting method used. So, but you got to talk to your tax accountant. I'm not an expert in any of that, and it doesn't affect what I do. You know, taxes are taxes. I just trade. UA as a short to 52. What do you think? Well, it's stalling out at the 50-day. So, you know, would I short it? I guess you could. If you're asking for my endorsement, the only thing I can endorse is if you think this fits the model and you think that you can make the trade, keeping risk in line, say by using the high of the day or the 20-day as your stop, then it's doable. But and does it fit our models? Well, yeah. You got a breakout attempt here that failed, so it's kind of a late stage failed base. So I think on that basis, one could test a short on it. So it fits the models in that regard, but I'm not necessarily endorsing it. Well, someone's asking about using stops or at resistance and trying to figure out. I mean, you can do all that stuff with the TZA or whatever ETF you want. That really depends on how you want to handle the trade. There's no one-size-fits-all absolute way of handling it. You could have covered part or sold part of your TZA yesterday when the Nasdaq undercut the lows of August, and and then see if you bounce. But our position was we had done pretty well, so we just decided to sit with it and wait for the market to actually turn us out, because you could get a 2-day blip, 3-day blip, and then roll over immediately. That's what happened on August 6th, if you guys recall, when the market broke down here and it turned on this big reversal day. And this was a heavy volume day. I don't have the volume on this particular chart, but it looked like it was going to reverse and head back up. The next day you gapped down and you just blew to the downside. So you don't really know for sure. So you can sell some of it. We don't do that, but you can do whatever you want. There's no one-size-fits-all. There's no absolute perfect black and white method to making maximum profits. So there's somebody. A lot of people who like your model, Dr. K.
No, thank you.
Let's see, a lot of comments. Still looking. NetEase, I mean, I think NetEase you have to lump in with all the Chinese internets, broke down, could have been shorted here. We went after Baidu, we went after Sina and all that instead. So it's just bouncing now, so I can't tell you how far it's going to bounce, and it's not one I'm playing. Do you guys know any day traders that can do 100% a year? I think I do, but...
Yeah, we know one. There's one.
Yeah.
And good long-term track record as well, but he used to make markets and stocks. He knows how things are fit together from the inside out through experience, and that
right.
I think is what separates him from all the other guys out there that attempt to day trade.
Right. Oh, here's I guess Thorne. I guess are you an accountant, Thorne? People misunderstand wash sale, says Thorne. It's only a wash if you hold the repurchase position after taking a loss at the close on December 31st. That's how I understand it. But you know what? I just trade. I don't worry about the taxes. I don't worry about wash this or dirty that or whatever. I just let my accountant clean up the mess at the end of the year, and then he tells me whether I made or lost money, and then I pay my taxes. So, I just don't get hung up on all that stuff. Am I stupid? Maybe. I don't know. With current volatility, would you suggest placing stops if I went 100% long in TNA this morning, Dr. K?
Well, as far as putting your stops on, I mean that is entirely subjective. I mean, it comes down to your risk tolerance levels, your position size in the ETF, and how much you're willing to lose. And if you want a pyramid piecemeal or you want to go all in, on one go, you have to ask yourself these questions. What is your risk tolerance profile? Every time you invest and you have a certain amount of your portfolio subjected to the market, you have to understand where your risk reward levels lie, and that only can be found through personal experience, trading your own account.
Someone else says here on wash sales, the IRS requires you to report wash sales even if there's no carry over to the next year. Yeah, I think that might be true. Whether they're taxable or how they affect your taxes, I don't really know. All right, last question. I think we're about to wrap up here. Seeing a similar position, this is all broken down. So, once we came down here, that was our price target. I think is this low here, and so you're below it. So you should you should have taken a profit down to here somewhere. Now you can kind of wait and see how this thing sets up again, if it does. So, but that was a nice move, And how far do you break? If you got short somewhere right off of here at say 99, 98. You broke down to 65. How many percent is that? Is that enough? Slop around in that mud for a while. That's pretty nice, actually. I'd take it. So somebody says that there's a CNBC portfolio management or money management contest, and some of the people are up 70% in 1 month. See, Dr. K, I told you we sucked.
Yeah,
that's the thing about the market.
play the TVIX and you'd be up, what was it, something like 400-something%.
Yeah, we do actually have one subscriber who's done it and made a ton of money. But that's I think points out that no matter how good you think you are in the market, there are all those people who are a lot better, and I can vouch for that. So while we like to revel in our successes, we do discuss our losses. I think we wrote a whole chapter on that one, Dr. K. And we might even, in the workbook that we're doing, I'm thinking about having a section on extreme bonehead errors that are done. So
yeah, chapter 4, failing forward in
asked.
our book. That's going to be a good one for our upcoming book.
Yeah. So somebody asked, is that a Mustang on your wallpaper? Actually, no, that isn't. What that is when I was a kid, our neighbors used to, let's see if I can get rid of all this stuff here. I don't think I can, but that is the rear end of a funny car with a Barracuda body on it. I don't know if any of you are drag racing aficionados, but as a kid, I grew up on the east side of Los Angeles, and our neighbors down the street, his dad was the pit crew chief for a guy back in the 70s who ran a rear-engine Vegas station wagon funny car, a guy by the name of Dave Bowman, who ran a car, the California Stud, and we used to go to the races all the time down at Orange County International Raceway. Now, where that was, I think Irvine is there now, or Orange County's been completely built over. When I was a kid, it was orange groves, hence the name Orange County, and just all agricultural, strawberry fields and whatnot. And out in the middle of it was Orange County International Raceway. Other raceways we used to go to was Irwindale, Lions Drag Strip. A lot of these are all closed up now, but that was in the day. And this particular car here, driven by Danny and Gaius, you can see here, is actually Big John Masmanian's funny car, and I love the Candy Apple Red. This was my favorite funny car, of course, other than Dave Bowman's car, the California Stud. And I remember one race we actually won back in like 74, 75, and raced Don Prudhomme, the Snake, in the semifinals and beat him to get to the finals. And just getting to the finals, I think where we lost to John Masmanian, this car was worth $40-something thousand in 1975. That was a lot of money. But anyways, I'm a big drag racing fan. Every year they have the Nostalgia drag racing event in Bakersfield at Famoso drag strip. It's really cool. So that's what that is, you guys. So you had to ask. So there you go. Anyways, let's see. Any last questions before we finish up? Maybe they're lucky. They might be lucky. I like this guy, Joe. I've had profitable trades on 19 of my last 20 trades. CMG, MON, TZA, Baidu, etc. Based on learning from your focus. Thanks. Best 2 months ever. Hey, that's what we like to hear. So, see, Dr. K, we are worthwhile and useful human beings after all. And all this time I thought we're just a couple of losers. Anyways, any other questions, people? I'm going to take 2 more questions on stocks before I shut it down. Snake no match for the mongoose, that's for damn sure. All right, yeah, there's a few of you guys out there, a few drag racing gearheads. I think cars are great. Is Yum? Okay, I'm going to take. Let's see here. Yum and Rim. So Yum, I don't know what it was. They're expanding in China these days. I wouldn't play this on the shorts. It'll go down with the rest of the market, but I use short Apple here. Short CMG, maybe short Amazon. They look shortable to me. And last but not least, we're going to look at RIM. I think RIM is a great example. I think when it was trading somewhere up in here, it was trading at like 7 times earnings, and a lot of analysts were putting buys on it in here because they're cheap. But, and I'm gonna bring this into a point about Apple, is that RIM was like 7, 8 times earnings up here, and of course now I think it's trading at how many times earnings now, Dr. K?
We're at 4, the big 4.
So now you're at 4 times earnings. Okay, so a low PE ratio is telling you something. That's why I ask myself every day, why does Apple sell at, well, I think now it's 10 times next year's earnings or forward earnings. Something's wrong with this picture, and I think we're finding out with Apple maybe what is actually going to be wrong with this picture. So we'll see. But I still think this thing's going to retest the 200-day. I think I'll eventually go through it. Whether we get to the 50-day first is another question. But I've got a few shares out on it right now on this bounce, and we'll just have to see what happens. But I do think this could be similar to 2007 when we saw Apple break. The market actually topped in here, I think, somewhere actually back in here. Apple has continued higher through the 400 level, and you can use Livermore's Century Mark rule in reverse to short at the 400 level. That's kind of where I started hitting it up in here. And Livermore would do that. So he did that with Anaconda Copper in 1907. It was going up through 300 and got up to about 308, 309, 310, and he was buying it, okay? Because once it goes through the Century Mark level, like Apple here on 400, it should continue higher. So you actually could have bought Apple for a trade, and Livermore would do that. He'd go heavy in, and he'd play this move for, really it's only 5%, but he would play it on a point basis. He was into taking points out of stocks. That was his big thing. And so he'd get heavy, but see, once it failed here, like Anaconda Copper at the 300 level, he would reverse his position and go short, and he did that with Anaconda Copper, and that also signaled the top of the market in 1907. Now, we saw Apple at the 200 level way back in 2008, and when it failed at the 200 level here, back in 2008, that's when the market started a new leg down. So in a lot of ways, we're seeing this market pan out a little bit similar to 2007, and so far with the Apple move. Now, if Apple continues lower, that's obviously going to take the market with it. And so I'd be watching Apple as a barometer. So we're seeing the market kind of give it up, so hopefully I'll make some money on my shorts today, but I'm looking at this more as a shortable rally than anything else. How long it continues will probably be determined by the model. So if the model goes to a sell signal, again, then I would be jumping on that right away. And you take your position, don't hesitate. He who hesitates is lost. Anyways, that's all I've got to say. Anything else to add, Dr. K?
No, I think we're all good. Just let's wait for this bounce, because ultimately the fundamentals seem like they just get worse day after day.
Yeah.
I guess it'll be everybody of Euro QE. You know, it seems like it's a weak solution. You know, the question's been raised: is Euro QE going to be as strong as U.S. QE was in 2009 and 2010, and I would say doubtful, because the European Central Bank is usually a lot less aggressive and slower to act and to print money than the U.S. government. So
yeah,
you know, we'll see it in the price volume action in the days and weeks ahead.
Yeah. Last question, USO. I think because it's relevant. You know, the breakdown you're seeing in a lot of the commodities like copper, like oil. I was just telling you that we're going into another weak phase in the economy and probably a double dip, assuming we ever came out of the first dip. So that's kind of how we look at the commodities right now, more as indicators of forced selling and also a slowing economy. So that's it, you guys. Watch for some GoView videos I might be putting out. What I think I'm going to do is probably try and do some videos around the closes over the next 2 or 3 days, depending on what happens, to guide any of those of you who are working on the short side on how we might handle some of these stocks, like the Amazon, Apple, CMG trio, which is the one I'm focusing on right now, I'll tell you the truth. And so I'll just kind of run through how we're looking to handle those. And as I just showed you, you can short these rallies today, I think. 300 levels your stop on CMG. Probably use a high today at 374 now on Apple. And Amazon, I use a high of 216 as a stop, and I think you can test these, and they're going to hit through their lows. Okay? That's it, everybody. Stay tuned. We'll catch you later. Take care.
Take care. So long.